Welcome to Pharaoh's Leadership. Today we're going to talk a little bit about the current housing situation. I know that for many of you out there, it's difficult to get a house. Many times you're making an offer on a house and there's multiple offers, or they're expecting more than the offers are exceeding the asking price, and you're having to chase the price upward. That situation seems to be coming to an end. Chairman Powell of the Federal Reserve basically says about the housing market that the Federal Reserve calls the exuberance in home sales and prices unhinged from fundamentals and abnormal for the first time since the boom in the early 2000s. If Chairman Powell is saying that it's unhinged from fundamentals, what he's really trying to say is that the prices can't be supported in the current marketplace. In fact, prices are getting well beyond people's normal incomes to afford it. People are affording less and less house, and eventually the marketplace won't handle that for very long, simply because as housing prices go up, less and less people can get into the market. Demand goes down, the supply remains or continues to increase, and the supply and demand have to balance at some point. Right now, demand has been outpacing the amount of inventory that has been available. So with the amount of inventory less, the prices will chase it upward until finally they can meet where the demand and slough off those people who can't afford to continue going up. It has a way of balancing out the amount of people looking for houses based on the amount of price that's being charged. It has a natural weaning effect on people being able to afford it. Therefore, it decreases demand at the higher prices. So it balances out that way. Well, eventually that can't continue to be. And in fact, what's happening is the Federal Reserve has basically said that quantitative easing will not be continued. It'll be slowed. And in fact, they'll start selling back some of the assets that they have acquired over time. And in doing so, they're going to actually reduce the money supply to a certain degree. Well, in the midst of all of that, they've got a situation where inflation is just going crazy. I know you've gone to the grocery stores, and my wife just has been complaining terribly about having to go and spend more. And I've got a daughter with some kids, and she's spending more of her budget and having to cut back in other places. So inflation is taking the bite out of everyone's paycheck. And of course, when that happens, you can't afford as much house either. And when that starts happening, the Federal Reserve says, oh, we can't have this happen and have everybody's paychecks being devalued constantly by that. So what the Federal Reserve then does is it raises interest rates so there can be less lending, and less lending means less mortgages. Less lending also means less money on cars. And so all of this, the economy just slows down. And when the economy slows down, interest rates or inflation rates begin to come down along with it. Paul Volcker was probably the most famous Federal Reserve chairman for having done this, and I lived through this in my early married life. When I was in my 20s, Paul Volcker had the interest rates up into the 16-18%, and that was for mortgages. Now, you haven't seen interest rates like that since the 70s and 80s, so it's a tactic the Federal Reserve has used many, many times to slow the economy down and stop the rampant inflation. So that is what the Federal Reserve is going to do. Well, the immediate impact of that is felt on mortgages, because mortgages will begin to be more expensive. They'll be harder to get. The lenders will tighten up their requirements simply because they want to make sure that the buyers are very strong, because if inflation continues to take bites out of their paychecks, they want them to, first off, continue to pay their mortgage. So the mortgage situation is going to get tighter. Now, it's going to be nothing like the 2008 mortgage crisis, where that was a problem with the investment banker situation that it hopefully is well behind us. That was when they stopped lending to people. It's not necessarily when the interest rates got too high. It was a situation where a lot of ARMs were put out there, interest rates reset on those ARMs, and people couldn't pay the higher interest rate when those interest rates reset. So in ways it's similar, but the dramatic turnaround will not be so hard to bear. It won't be nearly as dramatic as 2008. But let's look and see what is happening. Now, the United States, new home sales, there's two basic measures. There's new home sales and there's existing home sales. Here what we've got is a graph that shows that in January there was 845 million sales. In December there was 871, but see what's happening. It is a decline. Now this one's not as alarming. This particular trend isn't quite as alarming because here you've got these out here that were actually lower, but if you look at this 763, it was actually lower than the prior March that they don't show here. So this 763 is a little bit alarming. They did not expect such a significant drop. Even though the number of homes being sold was less, the price was still higher. The average price of $436,000 was higher than the previous year in March of $359,000. So we're still seeing a march forward in prices, but you'll notice that this was across the board. You'll see the South declined by 10% in total sales, Midwest by 8.7%, the West by 6%, the Northeast by 5.4%. There were decreases all across the country. What we want to do is we want to watch this trend going forward, because if you have any hopes of buying a house, if you can avoid buying a house in the next little while and watch this play out, you may well be able to afford a house that'll be less expensive in 6 months from now. We'll see. Now, if we look at existing home sales, this is where you see the real dramatic change. Existing home sales tend to be a little bit more level. You can see that they were recovering toward the end of last summer as the COVID restrictions were slowly being relieved, and you see it kind of topped out here in November and then dipped in December, but it hit its high in January. But after it hit its high, whoa, what happened? It dipped nearly 10% here. So it's a dramatic change from January to February, and then it continues its decline February to March. What we're starting to see is the fact that the existing home sales are being impacted by the Federal Reserve raising interest rates, and it's already being seen and felt in the market. Inflation is taking a bite, and interest rates have already gone up by a couple points, and so you're seeing that less people are being able to afford mortgages already. So there's less demand out there chasing the current inventory, which tends to soften prices as well. Although we're not seeing the softening of price yet, that usually follows 2 to 3 months later as people begin to realize there aren't as many buyers and they're not going to get 5 offers on their home when they try to put it up for sale. And so they're going to be a little bit more conservative as they price their home, making sure that it can sell. So I hope this analysis is helpful. It's the way I'm approaching my next home buy, and I hope this benefits you, and thanks for joining. Next video is on the screen. Hopefully you'll enjoy that as well. Thank you for joining.